Today's episode is all about inheritance. How do you think through it, especially if you're going, hey, I don't want to plan on it for my retirement, but I also know there's tax implications if I get money a certain period of time, but I know it depends on when I inherit that. And so I'm going to clear up all of this for you guys today. I'm going to start the episode with a story. I always want to make sure that I'm making content that resonates with you guys. As I've mentioned before, I listen to a lot of podcasts and I don't like fluff content. And oftentimes if someone who's a podcaster is like, hey, here's our announcements for the week, like I know me and I'm just like, great, let me skip this to get to the content I want to listen to. So I try as much as possible to not make any skippable content or skippable announcements so that you guys are listening to the whole show. I want it to be as impactful as possible for you. So I'm going to start with a story. Then I'm going to go through the reviews of the week, the hate of the week, or the interesting comment of the week, as I mentioned a few weeks ago. And then I'm going to go through those different laws and changes that might impact you. So if you have, inheritance that you think might come in the next few years, if you think it might be 10, 15 years, if you go, hey, I've got an inherited account right now and I just don't know what I should do, I am going to answer those questions. I just want to tell you this story so you can understand where I'm coming from and how I approach it with clients. So the way I want you guys to understand this is a child of a client came to me. They said, Ari, I heard your episode on inheriting accounts before. I did one a while ago. And they said, I'm really worried because, my father's your client and he's invested really well. And I'm just really worried. I said, why are you worried? And he said, well, I'm worried because if I inherit these dollars, I think I have to pay taxes on them. I go, that's partially true based on the type of account, Roth, pre-tax, etc. But why are you even telling me this at all? They go, well, I'm telling you this because I think I'm going to quit my job. I said, why are you going to quit your job? And by the way, guys, I know my clients very well. I know this child very well. It was kind of out of left field kind of a thing. So I said, why are you going to quit your job? They said, well, I'm going to quit my job because I don't love it. I go, that's not why. You told me that you really want to be a physician, and so I don't believe you. They said, okay, fine. The reason I'm quitting my job is because you said on the podcast that if something happens, I'm going to be paying taxes on these dollars. I said, okay. They said, well, I'm going to be a physician and I'm going to be in a really healthy tax bracket. I'm here in California just like you, and we're getting crushed. And so because of that, I don't want everything my father worked so hard for to get taxed at the highest possible tax rate. I said, okay, let's stop right there. Are you telling me you're no longer going to become a physician because your father invested well? They go, yes. I go, that's not logical. They go, Ari, I know that. I can't imagine this is the first time a client's approach you with something like this. This is not about logic. This is about the fact that my father is not from this country, invested really well, did all the right things, and I don't want him paying more than he needs to in taxes. I said, okay. I need to think about an example to illustrate this for you. They go, Ari, I don't care what logic you tell me. It's not going to resonate. I don't want to be a physician. I said, okay. So the point of this story is not to scare all of you, but there's a risk of investing too well, where now all of a sudden a child alters their future. Now, we had a long conversation, and the child is still going to become a physician, and we're going to be doing good tax planning. This is before we discussed that. So they're going to be fine, and they're not switching their career. But the point here is I say there's the risk of bad planning and the value of good planning. Many of you know this, but my parents were burned by multiple advisors, and that's why I am an advisor. And if you're not doing it well, meaning just financial planning in general, children might take a whole nother position that they don't even want to take. They might not work. There's a risk if you invest so well that your children go, well, I don't need to work. I'm going to be fine. There's another risk where you don't give them enough while they're still alive when you could actually help them, and now you pass away with $20 million. So there's, of course, a balance to be had here. The point of the story is I don't want you to invest so well that you now alter what your children were going to do. Now, it's very rare that this is even the case, but I like to start with the story, and then I'm going to go through real inheritance examples and how you should think through all this stuff. So don't want to start on a sad note by any means. It ended very well. The client is going to become a physician. They're happy about it. There's no concerns there, just so you guys know. So what I'm going to start with now after that story is the comments of the week. So these are comments, once again, every week, I'm going to pick the very nice review of the week and highlight that, I'm going to pick a comment that's either hate of the week or just an interesting comment that I want to highlight. So this one happens to be both. So on a comment of a recent video, this comes from Bob's4718. And if you're listening on the podcast app, great. If you're on YouTube, you can see it right here. he says, who wants to be the richest person in the graveyard? Seriously, die with $0. Enjoy the life you work so hard for, not leaving it for anyone. So on that comment, if you haven't read the book Die with Zero, I highly recommend it. I don't think it's perfect, and no book's perfect, but I like the approach, which is essentially, hey, live the life you want to live. You don't get extra points dying the richest person at your grave. A lot of you are going, hey, I've got inheritance coming in, but I don't have kids. So like, I don't want to die with $10 million. I'm like, great. I think that would be a failure if you did. And so I'll joke with clients and I'll say, what is your estate plan? And they're like, I have a trust, or, I have a will. I go, none of that is estate planning. Those are just documents. What is your plan to make sure you're not in your 70s with $10 million wishing you would have spent more when you had your energy and your health? That's estate planning. So some of you are going, yep, that's exactly what I'm trying to do. Some of you are like, hey, I want to leave $2 million to each child. I just want to make sure I'm not a future burden to my children. I also want to make sure, I'm helping myself along the way because they can make more money if they need to because they have time. So understanding this comment, I get it. You don't want to die with the richest person in the grave. I agree. I just want to make sure estate planning, it's different for everyone. So what I don't want you to do is take a cookie cutter approach and go, well, I don't have kids and I'm not married. And so because of that, I'm going to have the same retirement plan as my neighbor and I'm going to retire at 60 just like them, or 62. Don't do that. If you don't have children and you don't want to give $2 million to eat 3 different kids, hey, you could retire a lot earlier and you can spend way more. Not because it's good or because it's bad. It's just, that's the reality. If you want to give $5 million to each child, and I have clients that want to do that, I say, great, here's what's happening. You're working 7 more years and you're traveling to this degree. And they're like, cool, I'm happy to do it because that's what I want to have happen at the end. I promise, guys, no advertisements on the show, just a quick pause because I have a fun, exciting announcement for you. I don't get to work with all of you, most of you, and I recognize that. And I'm the first person to say, hey, it depends when you want to work with an advisor. Oftentimes I'll say, don't work with an advisor unless you have a certain asset threshold, or if you're just the type of person that's like, hey, I just don't want someone else managing my money, but I still want guidance on all the strategies you talk about specifically for an early retirement. So the exciting announcement is June 1st, I'm coming out with my Early Retirement Academy. I sent this email to a lot of you a few months back saying, hey, it's been in the works, I'm working on it. I've been putting more time and energy and effort into this than you can imagine. And it's not going to be for everyone, but it's going to be for those that are saying, hey, I want access to the tools that you use on the YouTube videos. I want to run my own projections. I want that software. I want to make sure I'm not overlooking anything for my retirement. And I want to make it affordable for all of you. So what I'm doing is I'm putting that together by June 1st. It will be completed. And so if you want a discount code before it launches, there's going to be a survey in the description of today's episode. You can fill that out and that will put you on my email list so that before I actually release it, I'll give you the discount code and you'll have that before I launch it on June 1st. So just quick announcement there. It's going to be an early retirement academy specific for that. Will be everything you need to know if you want to retire early and run your own projections. It's not going to be, you're speaking with me or my advisors. That's when people are working with me. But some of you are like, hey, I don't necessarily need that. Maybe in the future, but it's just a timing thing. And that's what I'm big about. When people say, when should I work with an advisor? I say it depends. I just don't think everyone needs one. It's based on the stage of life you're in, the level of complexity and things like that. So I want to put something together to help as many of you as humanly possible. That's why I do what I do. So keep your eyes peeled for that. Fill out the description in the survey, and let's get back to today's episode. Then the hate comment is a reply to this comment. It's really not a hate comment, but this comes from Katom Cozies, so Katom Cozies. Sorry if I'm not pronouncing that correctly. And they reply, they say, ultimate boomer comment with the laughing emoji. Hope you leave something for your heirs. And so you might read that or hear that and go, hey, that's really mean. They're calling this person a boomer. And so I'm going to read to you the reply from the original person who commented the first comment. So the first person, once again, the Bobs4718, he said, who wants to be the richest person in the graveyard? Seriously, die with $0. Enjoy the life you work so hard for. Not leaving it for anyone. So the person replies, ultimate boomer comment, hope you leave something for your heirs. So the first person says, hey, yes, boomer is indeed the case. I just loved his reply. He goes, yep, boomer is indeed the case. Like, yep, owning it. In the same way, a lot of you are like, hey, why are you talking about retirement planning? You look like you're 12. It's like, I love this stuff more than anyone you probably know. And so like, yep, I'm young. I love it. That's me. I'm weird. So yes, boomer is indeed the case. We have no kids. Only nieces and nephews, and we already spoil them rotten. Money left behind for others is okay, but time spent and money spent on family while you're still alive is so much better. It's about the experience, not the money left behind, spending every cent. So I love it's not right or wrong. It's just, I love the way he's like, hey, I want to help. I just want to help while I'm here. I don't want to die with a gazillion dollars. Let me understand, once again, that I have a different situation. And so I think when he was maybe replying with that comment, or she or they, never know nowadays, I want to make sure that they are absolutely looking at this in their specific lens, not because their neighbor or coworker or any of that. We have a phrase for that we call head trash, where oftentimes if you're retiring early or thinking about it because you are in a good spot, but your neighbor isn't, your coworker isn't, your friend isn't, you're like, hey, maybe I'm not in a good spot. No. That's head trash. You could be in an amazing spot and they might not be, and that's just the case. So that is the comment that I want to go through. Now that we've been through the little story and the comments of the week, the real question a lot of you are asking is, hey, I'm going to be inheriting some money. I don't know the tax implications. I don't know how to think about this. Before I give you a 30, 40-minute lecture where half of you are trying not to fall asleep, even if you're nice and trying to listen to me, there's a flow chart that we created, okay? So what I want you to do, I'm going to put it up right on the screen right now so you can see it if you're on YouTube watching. If you're on the podcast and you're just listening, that's okay too. It's in the description. So you're going to see me go through this. The best thing would probably be pulling it up while I'm actually going through this, but you don't need to do that. If you're driving, don't get in a car crash or anything crazy like that. Some people tell me, hey, I listen while working out. I'm like, hey, if you can listen to me do tax planning while working out, like, kudos to you. I listen to history podcasts while I work out, but once again, I'm weird. So this here of, can I delay distributions from the traditional IRA I inherited? That's the question I'm going through. So some of you are like, hey, I'm not inheriting a traditional IRA. I'm just getting a brokerage account, or I've just got cash coming in, or my parents are going to sell a home and I'm going to get a portion of that. It becomes complicated quickly. This is why we exist as financial advisors. So if you are looking for a holistic approach for everything, not just the investment stuff. So I'll joke with my clients, in new clients specifically, I'll say, hey, if you reached out and you only want investment guidance, meaning no tax or withdrawal or state, healthcare, insurance, I go, don't hire us, okay? Hire 10 firms down the street. I might even help you pick which one, because they don't do what we do. We do holistic, which is everything. Some people don't want that. Like, great. Once again, we're probably not the best fit. We're the very first person. I'm the first person to put my hand up and be like, we don't work with everyone. We work with those that want the next level of planning, and the specific tax planning is what we specialize in. So the question here for a lot of you is, hey, I inherited a traditional IRA. You might be the spouse of someone, meaning someone passed away, someone very near and dear to your heart, and you've got this IRA, you're like, I don't know what to do. You might go, hey, I'm the child and I don't know what I'm going to do. I'm going to inherit this in 6 months, or I'm going to inherit this in 2 years, and so I want to plan for it intentionally. Lots of different tax planning stuff. So this flow chart is something you can go through, and it's very, very easy. That's why we created it. You can go, did my father or mother pass away at this time? Okay, yes, it was before this period, so here's what this means. Now I'm going to go through it with you now so you can hear me explain it. But if you just want to see it for yourself and take some more time and just figure out the answer, you can absolutely do that as well. So this is why I do that. Now, there's a few things I want to bring up here. The few simple answers, once again, I know all of you are very busy. As much as possible, I want to give you the answers right away. Real quick, just some loose stuff. If you're a spouse, you've got more leeway, way more options. So don't stress if you're a spouse. A lot of different choices. You can make the IRA your own. You can roll it over into another account. You can make yourself the beneficiary. You have tons of options. So not that you're stressing, but if you're like, oh my God, my spouse just passed away, what do I do? You're going to have more flexibility than if you're inheriting this as a child. Now, in terms of inheriting an IRA, you definitely need to make sure you're doing the right rules, because if not, the taxes become a little crazy. Now, it becomes, once again, complicated very quickly, but you've got two options if we're putting it really simple. You can transfer the assets into an inherited IRA in your name, and now you're choosing to take these, what are called RMDs, required minimum distributions, over your life expectancy or that of the person that passed away. You're like, hey, what is that in English? I'm going to go through it in a second. The other option is you can transfer the assets into an inherited IRA. So once again, it's an IRA of, let's call it my mom, Susan. Susan passes away. Hopefully not anywhere time soon. But Susan passes away. I'm now going to make it Susan's inherited account. So once again, my name's Ari. I can make it Susan's inherited account. So I can transfer that into an inherited account. I can do that. And I can choose to take the distributions over 10 years. So once again, let's go back to that first story. The child of the client was like, hey, and I'm not going to say their name because they didn't want me to. So they said, hey, don't use my name if you're ever going to tell this story. I said, okay, I won't. So They said, well, Ari, once again, I'm going to become a physician, a high tax bracket. What do I do? Well, let's assume they're in a really high tax bracket and they're like, oh my God, I think I have to take this money. And, my father invested so well. I'm so scared. I have to pay so much in taxes. I go, you will, but you can be strategic here. You don't have to take it all at once. You can take it. We just have to take it fully by the end of the 10th year. So let's assume you have an epiphany after 5 years. You don't want to become a physician and you stop working. Your spouse stops working and there's no income. Well, that might be a great year to take more of the account because you don't have as much taxable income. It just has to be completed by the end of the 10th year. So you're, so there's more strategy involved. Yes, there is. So this is why I say tax planning is integral. Now, it must be liquidated, meaning it has to be zero, by December 31st of the year that is 10 years after the original owner's death. So lots of options and planning and things we're going to talk about on this. The main things here, I've got my little checklist. I want to make sure. Estate planning and rules, lots of stuff are changing. The kind of easy, low-hanging fruit, don't ignore beneficiary forms. I've seen it where the beneficiary was not listed correctly and they were going to get the assets because it was clear that the name was just misspelled, but it was a hassle. So make sure when it comes to prepping your estate plan, you've got all the right things in place. Some of you have asked me hey, I don't have a trust. Does that mean I don't get... No. Trusts and wills and medical directives and power of attorneys, all important stuff. That doesn't apply. If you have an IRA, you don't need a trust. You just list a beneficiary directly on there. It's the simplest, easy way. Don't overcomplicate it. If there's no designated beneficiary, then it goes to the estate. And the issue there is the beneficiary will be stuck with a 5-year distribution rule instead of a 10-year distribution rule, and it becomes a whole lot more complicated. So a lot of these forms are misleading. More often than not, I just tell my client, would you please let me fill it out for you? Now, for compliance purposes, let's make sure you understand what you're signing, why you're signing. I'm explaining it to you, but we're just doing it for you because you can click one box incorrectly, and now it's a hassle. And then lastly, some people are like, hey, what about that Roth IRA? Roth IRAs are awesome. If you're inheriting a Roth IRA, there's lots of different tax planning things you don't need to worry about. So oftentimes you're like, oh, what do I do about you still have to take money, but not taxed, and a lot of different planning tools. So don't stress about that. So this flowchart that I've created for all of you, you're going to be able to read it. So if I'm reading it with you right now, even if you're just listening on the podcast app, that's okay. The first question here, you're going to see in the upper left where it says start here. It says, did you inherit a traditional IRA from an account owner other than your spouse? Okay, other than your spouse. So let's assume the answer is yes. So yes, you're inheriting it from someone other than your spouse. Let's call it your dad. Okay, great. Got that. From there, did the owner of these IRAs, did your dad pass away after December 31st, 2019? Okay, got it. Let's make sure, once again, let's keep it English here. Let's not make it Portuguese. Okay, so I had a dad, they passed away. Wasn't fun. From there, they passed away. Yes, it was after 2019. Let's assume they passed away last year. Got it. So 2023. So we follow the chart. Did they pass away after? Yes. Okay, keep going. Was the owner, you're going to see the little arrows you can follow, was the owner of that IRA the account's original owner? So you're like, okay, let me make sure. My dad passed away in 2023. Were they the original owner? Okay, did my dad inherit that from someone else, or did my dad first open the account? Okay, my dad first opened the account. Great. And so was he the original owner? Yes, he was the original owner. Next question. At the time of the owner's death, when the father passed away in 2023, were you either a minor child of the owner, fewer than 10 years younger, so less than 10 years younger than the owner, disabled or chronically ill? Okay, so let's assume the answer is no. Okay, so let's assume the answer is no. You were not a minor child. You were not fewer than 10 years younger. It was much more than that. You are not disabled and not chronically ill, which is the case for 90% of you, 95%, okay? So then you're going to see it says you are a non-eligible designated beneficiary. What does that mean? Okay, you are not subject to RMDs. That's the first thing it says there. So once again, my job oftentimes is telling clients, hey, don't worry about it. I teach my clients, one of the things you're going to start to say is, that sounds interesting, but it doesn't apply to me. Because all the time, your neighbor and coworker friends go, hey, didn't you hear that rule changed and you should do this and that? Hey, that's great. Sounds interesting. Doesn't apply to me. So you're going to see the first thing there. You are not subject to RMDs. The greatest deferral allowed is under the 10-year rule, by which you must withdraw the entire account balance by the end of the 10th year after the year of the prior owner's death. Okay, total English. Let's hit it. Okay, your father passed away in 2023. Now you're going, what do I do? Okay, if you were not disabled, fewer than 10 years, all that good stuff I just went through, you have 10 years to take this account, and you can be strategic as to how you take that. Now, there are rules that are changing. They're saying you have to take a portion every year, and a lot of different nuance here, okay? But the point here is the loose current legislation today, and I call it loose because it feels like they change it every week. But this is how I want you to think about it. And you might go, whoa, okay, so I've got some options. You do. Now, you need to be strategic. Now, let's go the other way, okay? So some of you, I'll tell you right now, tune out. This is now, I'm going to go through it. What if it's the opposite? What if you're like, hey, no, I've got like a brokerage account, or I got this, or I got that. Okay, keep listening. But I don't want to make any of you listen if you're like, hey, is this next section going to apply to me? Now, some of you are like, listen, I'm just going to listen because I don't know if it does or doesn't apply to me, which I understand as well. Let's assume you inherit a brokerage account. Your dad bought Apple stock for $10,000. Now it's worth $10 million. And you're like, Dad, I really miss you, but you gave me $10 million, so like I appreciate it, but doesn't replace having you. But like I think I'm going to pay a lot in taxes. No, okay. So with a brokerage account, there's a step up in basis. So you're inheriting it as if you just bought it for $10 million. You're like, well, what about the taxes from the 10,000 to 10 million? Don't worry about it. Okay, it doesn't apply to you. Now, this is very rare. I'm just going to mention it because it comes sometimes. There's something called net unrealized appreciation. Don't worry about the details because you might fall asleep, not because you're not competent. It's just you're not doing it all day, every day. Here's the basic premise. Let's assume you've got $5 million of Apple stock, but it's in your 401k. Okay, whoa, that's very different. 401k, brokerage account. So it's in your 401k, meaning you have a lot of company stock. Okay. When you do that, you invested well, like good for you. But now you have a choice. Most people say, yeah, I'm going to move that money that's in my 401k, that's Apple stock, to an IRA. Okay, I'm going to move the money. It's called a rollover. Great. You might not want to do that. And the reason you might want to do that is when you take that money out, it's ordinary income. You have an option to use what's called net unrealized appreciation, where instead of moving this big concentrated stock position in your 401k, you can say, wait a second, I have an option. I'm going to go ahead and use my card, my NUA card, if you will. And what that allows you to do is say, I'm going to intentionally pay taxes on the original cost basis so that the rest of it moves to a brokerage account. You're like, whoa. Brokerage account, why that versus the IRA? Brokerage account gets capital gains tax treatment. It's more preferential. It's better than ordinary income treatment. So the point here is if you do that, some of you are like, ooh, can I skip the rules here, maybe do this NUA thing, and then all of a sudden, it's all in a brokerage account, and then I pass away the next day, and then, my child doesn't have to pay tax on it. No. Okay. So there's a lot of rules and nuance here that gets confusing quickly. But the point of it, to keep it simple, is if you're going down this flow chart once again, and you're like, wait a second, did I inherit this IRA from someone other than my spouse? Yes. Okay. So once again, you inherit from your father. Did the IRA owner pass away after December 31st, 2019? Before we said yes, now let's assume no. Let's assume you inherited this before 2019, okay? You're like, oh my God, what do I do now? Oh my God, how do I think about this? Do I quit my job? No. Okay, you don't freak out. You work with a planner because the rules are very, very different. But to keep it really simple, the RMD changes and the applications and the 10-year rule, it becomes overwhelming. What I'll say here, refer to the flow chart, but understand the details are going to very quickly. Here's what I'll tell you. Most of you are like, listen, I think I get the basic premise, the asset allocation and Social Security and tax planning in general. But when it comes to inheriting and tax planning and the strategic, I've never had someone come and be like, hey, I've got my tax plan for when I inherit this account. Can you just validate? That doesn't happen, okay? Because this is the nuanced level. Go to the flow chart. You can see here, there's a lot of details. Don't get lost. What I want to do today is make sure you understand simply, how do you think through this? Roth IRAs, specifically if you're inheriting those, what potentially might you have to think about? If you take it all at once, are there tax-free consequences? Guys, don't burn yourself where you're trying to become a financial advisor in retirement. Okay, this is what we love spending our time doing. This is all we do. So if you are looking for assistance on anything inheritance, things like this related, this is what we do. Okay, so don't freak out if you're like, oh my God, I don't know where to go. What do I do with this stuff? That's what we do. What I want to make sure you guys understand when leaving all of this is, if you're going to inherit accounts, it really is intentional to be strategic about the timing as to when you take that money. Now, you can't be strategic as to when your father, mother, etc. passes away, but you can be strategic as to how you take the income. And what I don't want to have happen, and this is my final message for all of you guys before we tune out for today, is you go, wait a second, I'm not going to be strategic with tax planning. I know I should, but I'll get to it when I get to it. And then here's what happens, because I've seen this. Social Security gets turned on. You have required minimum distributions from your personal IRAs, pre-tax accounts, 401ks, etc. So Social Security, your pre-tax accounts, there's a pension, there's rental income, and now you've got inherited money. And now you're getting taxed out the wazoo. And you're like, well, why didn't I think about this stuff earlier? That's why I'm bringing it up now. So I joke that I'm the meanest early retirement advisor. My job is not to be your best friend. My job is to give it to you straight. And yes, we can be friendly. So I want to make sure you are not paying more tax than you need to. That's it for today's episode, guys. Hopefully this was helpful. If it was, I know I don't get to work with all of you. Please do, of course, leave a review if this has been helpful. Leave a comment on YouTube. Let me know if you want more content like this and what other content you're looking for. And finally, it's more fun to retire with a friend. So I encourage you, if you don't mind, sharing this with someone that you want to go travel with and have fun with in retirement, even if it's your spouse. So hopefully, guys, this was helpful, and love you guys. Talk to you next week.